right,
Yeah.
here now with more is Tom Finke or Fink?
Fink.
Lose the E, Tom.
No, that's what separates me from Larry.
Oh, okay. And you want to be, okay.
Yeah, well,
Larry's great. Anyway, Chairman and CEO of Barings, a $325 billion global asset manager that invests across public and private markets. Tom also runs one of the largest high yield and private debt teams in the industry. And did you ever think you'd wake up every morning and globally see the situation we have? And were you prepared for it? Were you set up right for this environment?
I think we were set up right over the years because we've really never been one that bets on rates and makes that move a sort of a top-down investor. We're more a fundamental bottoms-up credit investor. So we're always looking at companies and finding value from the bottoms up, aware of these issues like where we are in rates. But it's extraordinary times.
Is it? Well, maybe the other things were extraordinary.
Well, they were all extraordinary.
Right. But what's the norm? What is norm? Maybe we were too high for a while, weren't we, Leisman?
We might have been. You could say that relative to other countries, we were too high relative to maybe the underlying inflation.
Maybe the 70s put us in this weird 19.5% interest rate environment that we thought was normal, and we thought 7 was low, and maybe it was always high.
Yeah, maybe. Tom, Rosengren yesterday said the lack of the low spreads on high yield is an indication that the economy is not as bad as people think. That is one interpretation. Right. The other interpretation is rates are so low, people are reaching for yield, and they'll take any 10th or 20th or 30 basis points that they can get. What's the answer for why the spreads on high yield, which should be so much higher?
Those aren't mutually exclusive.
They're not. They're not. But I just think is it reaching for yield, or is it an assessment that the credit is good and the economy is not in bad shape?
Our view is a little bit in the middle, and what I would say by that is there's definitely a lot of capital in the system, or a lot of liquidity to the markets these days. And certainly when the spreads widen out, you see a floor come in terms of buyers like ourselves that will buy value. That said, we think there is still overall a strong tone to the economy, moderately strong, but we're very worried about certain sectors. And I think the default rate being so low, that's going to move up more when you see certain sectors like retail, which we've seen recently, continue to have issues because of the competition from e-commerce. And so it's a mixed, it's sort of the middle of the road. It's not it's not 06 where things were so tight and the system was so levered. It's a lot more moderate.
So I know you're bottoms up, but can we just do do you have a recession call? Have you moved it from 35 to 36 or over the next 12 to 18 months?
Our view is a recession is eventually likely in the next couple of years if we see things kind of continue to pan out.
So you don't have an actual number like some firms where they go from 30 to 40, which is still...
No, I don't do a number.
It used to be 70% we won't, now it's 60% we won't. It's all useless, but they seem to like to do that for some reason. Anyway.
Well, that's why the economists do it. CEOs just go in there and say, how am I going to run my business?
But what about your book? Does your book send a signal if you look at the high yield number? If you were saying, okay, I'm looking at my book for a signal here from recession, what happens to the high yield? What happens to the fixed income market before, other than this inversion?
You're really not. If you look at with high yield, we really start looking at the weakness in industries first. And so if you start seeing a lot of industries stack up, if you just start seeing the traditional cyclical slow down, certainly if business investment continues to slow, you got an issue.